Starting, all attendees are in listen-only mode.
Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the financial trading week ending January 9th, 2015, really the first full week in 2015. What I've got on the screen here is a daily chart of the E-mini S&P 500 futures. And as you can see, we've had a nice little run here. And it goes way back. In fact, this particular chart right here, you can see that we go back through 2009, right over in this area here. And we've honored this channel all the way through, and you can see this yellow line here is the 200 EMA. And it has been running in an upward trajectory of this channel very nicely. Now we're starting to get separation as our trend is getting a little bit long in the tooth here. We've been really in a strong uptrend since March 6, 2009. And you can see here we've accelerated a little bit up, but the 200 EMA is starting to get a little bit of separation from the channel. And the reason why is we're having these larger dips, as you can see here, that are starting to occur more frequently. Back here, when we entered this channel, in 2000, in this particular one here, several years ago, we really did not have any outside movement of the channel. And this was an intraday, but just barely, and then we quickly got back up and regained towards the upper part of the channel. But really, only just recently, you can see here, there's one, there's two, and then this most recent one, 3 times, we're starting to penetrate this channel. Now, for those of you that are relatively new to trading, generally when a market is running up and it starts to get towards a more of a peak, the acceleration accelerates. You can see here, this vector runs like this, and then all of a sudden we got an acceleration of the vector of the price, and then we start to get a lot more chop, and it can drive you crazy before the market says, what are we going to do? And the odds favor a further pullback to a primary support area to consolidate before it makes another run again. I think right now we're kind of in this mode right here with the markets. Now, for those that are our members in our group, we did, this was a really nice trade for us because we had this tremendous bearish divergence set up between this peak here and this peak here. So we played this to the downside. But I want you to notice that, and I've talked about this before. In fact, one of our folks sent me an email on it as well. You can see that almost every drawdown here, like this, is met by a sharp reaction back up, a V bottom. Now, and this statistic that this gentleman sent me said that generally, and I would agree with this. I've talked about V bottoms before. That's when the price action does a hard dive like this and then does a hard counter reversal like that. Generally when prices go down and it starts to find a bottom, it'll come up and it'll do a retest, maybe even do a lower low and get a little bit choppy and then slowly start working its way back up, you know, in one of these kind of rounded fashions like this. However, we've had this V bottom here a lot more than we've normally had, and really the only thing different, and I would agree with the writer of the article that pointed this out as well, is that, you know, with all the QE that's coming out, every time we've had a sharp downturn, and it's not really sharp, but it feels that way because everybody has been long for quite some time. Every time we've had these sharp downturns, someone comes out, whether in Japan, China, the U.S., Europe, the ECB, and says, well, we're going to, you know, keep interest rates longer or lower longer, or we're going to put more stimulus out there. Then you've got this big, huge bottom right here. And all this money printing and all this money gets into circulation. It goes somewhere, and it goes into the equity market because that's where the highest yields are at the moment. So they've, in some respects, have created an artificial environment here. Now, eventually, this is all going to end, of course. But right now, we're getting ready to come up on a key date, January 22nd, which is when the ECB has been pressured, I would say, by market conditions across the 18 countries that make up the euro to do more stimulus. So as you can see here on this chart, we've got this V bottom here, and if I just blow this up a little bit, you can see right now, and our members, we played this to the downside, so it was a nice play for us. We also played this to the downside as well. So you can see where we're sitting here, and we ended Friday on a down note. The S&P, or the SPX, the cash index, was down 17.33, and the Dow was down 170 points. So we almost gave up everything that we made on that big rally on Wednesday and Thursday. But you can see here where we're sitting right now. The opening price of 2015 was at this blue line here at 2055. The intraday high for 2015 is 2067. And now you can see where we're sitting right here. Again, like I instruct our members, the best time frame to use against a 2-hour chart is against a daily chart is a 2-hour chart. And and it is always, as you can see here, we were in this channel making lower lows and lower highs. When we took out that high right there, I told everybody, be ready, because we're going to take off, and we did. We started making higher highs here, and that kind of shifted the movement right here. You know, we went through this change in trend on this 2-hour chart. So now we're coming back down here. The key right here is 2024. Check that number out on Monday. We do not want to take it out. We don't want to come back down below this key pivot. If I clean the chart up a little bit, I'll show you how it looks here on the 2-hour chart. But you can see right here, it held for quite some time, for several days. And then we finally broke it right here. We broke out, and we broke out on that big bar right there. So it was a vengeance. I mean, we came out, and I told everybody that it looked like a little bit of a bear flag, and I said the odds favor a breakup, and that's what we did. And we came right back up, and we actually were in the positive for 2015, and then we gave it all up. We had a little bit of a final thrust here, and then boom, we're rolling back down again. So again, 2024 is our key number on the E-minis. Okay, we want to watch it. If we take that out, our primary pivot low is all the way, it's all the way down here. Okay, right around 1984 area. If we take that out, then we're going much, much, much lower. Okay, so again, next week's going to be a really interesting week. And I think we could be, the other scenario that I didn't talk about too much in our price action is that we could stay sandwiched. I talked about it briefly, but we could stay sandwiched, in this range right here. And we're just going to work our way in this area until we determine whether we break the upside or we break the downside. Now, keep in mind, we got the ECB coming out. We got the FOMC later on this month coming out. So we're going to have a number of trigger points that can set this thing off one way or the other. I think right now the odds favor, in my mind, a break to the downside. Okay, which means we're going to go lower. I don't see any evidence of a stronger move to the upside just yet. But this is kind of where I'm looking at this right now. And you can see this big down move right here. We went from a sell on the rally to a buy on the dip mode. And then we went back to a sell on the rally, and now we're back into a buy on the dip. But should we come back down and take out 2024, we're going to come in, we're going to take out this key pivot right here at 1984. And then if we take out 1968, maybe a little bit lower here down around 1961, then it's going to get a little bit ugly. Okay. If we step back out to the daily chart again, you can see this 1968 area. It's a key area, and it held up right below. That's the 200 EMA sitting at 1953, and then we've got this zone right here that's acting as a support zone from prior pivot highs. So we've got to watch this very, very closely. All right, I mean, we got to be pay particular attention to it. If we look at the Russell. And again, it's a very, very busy chart. And the only reason why I did this for a reason. This busy chart here, this was the high point and this was the low point in all of 2014, except for as we came down in October as we rounded out the end of the year, which was about a 14.36% drop from a 2014 high. So we had a 10% correction in the E-mini S&P 500, not quite 10 in the Dow, but we had 14.43 or 36 rather in the rut. And then the rut, as we started moving back up, actually outperformed the Dow and the E-mini S&P 500. But now we're getting to a critical stage here. And I just don't think we're going to be able to get up over this area. If we do, this will be a good positive sign. That was a 2014 high. Actually, we made a 2014 high over the last few days. We took out that high the last few days of 2014. Okay. And then I don't know if we're going to be able to take that out. If we do, then that's going to be very positive for all the other markets. But you can see just how volatile the Russell has been. I mean, we've stayed sandwiched in this range right here. And the Russell has tested both extremes many, many times. I mean, we're running, down to the bottom, up to the top, way down, way back up. Like it's just extremely volatile, the rut. And then we had this really nice bearish divergence set up for this big pullback right here. So it's just the small cap has not performed well in 2014. I've heard speculation that the small cap's going to do better in 2015, but I need to see it. I don't see it yet. And that's not to say that it's not going to happen, but I do need to see the small cap come forward here. The other one that has surprised everybody, and the screen goes white until I put the chart up here, is Treasuries. If we look at bonds here, bonds has just been on a tear. This chart right here shows 2014. This was right at the beginning of 2014. And I've got the shaded blue lines outside of the channel here just to kind of show you where the markets run. And this is just done very, very well. And me included, if you had talked to a lot of professional traders and said, will interest rates go higher at the beginning of 2014, just about every one of them said yes. But that didn't happen. But you can see where we're sitting right here now, and we're right at this area here. Should we get that pullback in the equity market, you're going to see bonds continue to ride this upper channel up here. Right now, we're in a bullish mode on bonds, okay? And interest rates are very low. This is what happens when you get a lot of money circulating around in the market, and you got a lot of money coming from Japan and Europe into the U.S. Treasury market, because the European bonds are very low right now, all-time lows. I think I told our members a couple of weeks ago that this is the first time in I think ever that the major economies of the world, the major treasury markets below, on average, 1%, the 10-year below 1%. So this is, and having the equity markets at near or at all-time highs also, primarily in the U.S. markets, just really amazing to me. So this is going to be really interesting for 2015, where bonds is going to wind up. Now, this is going to be a great trade for our members when we get a break of this channel and we start moving down in bonds. I don't think 2015 we're going to get a huge down move in bonds. I think interest rates are going to stay relatively low through much of 2015. I think the race for higher rates is really not going to start in earnest until 2016. But either way, what I think doesn't really matter. We're going to follow the charts. And we've been following the charts now with bonds, and it indicates that bonds are up. We don't have too much bearish divergence in the trade here. We got a bifurcated bearish divergence signal down here. So that tells me that any down move is going to be met by buyers. And it's really hard to predict just how far down that move will go. The other one that is really interesting to me is the U.S. dollar. Now, we've been long the dollar. For our members, we've had pretty good trade on with the dollar. Look at the dollar here. There is no bearish divergence. I mean, this thing is just a rocket ship straight up. Just a beautiful trade. Now, which means that the dollar is this strong, the other currencies are very weak. And if they come out and they do the stimulus that they're talking about doing in the ECB, well, then look at the euro. The euro is, let's just get it back up here. The euro is very low. We've taken out 119. We're now down. We came down and made a low here of about 117. If I move this thing out to a weekly chart, the euro has been a great trade for us. You can see we took out that key pivot point right there. That was a key pivot point for us. Now, if I add a little bit of perspective on it, I'm calling for the euro down around 1.09. So that tells me that there's more downside action in the euro. Should Draghi do more stimulus, you're going to see the euro start working its way down to 1.08, 1.09, and you're going to see the dollar continue higher. By the same token, and by the way, FXE is the trade for the euro if you can't trade Forex or futures. British pound is the same. Here's a weekly chart of the pound. Let's get it back up here for you guys. You can see right here we took out a key pivot point, a Fibonacci of 0.236 at 1.52, and we're sitting right at this area here. So I think we're going to come down definitely and test 1.48. We may even come down and test 1.42. So again, more downside action on the British pound as well. Okay, so that's a little bit about where we're sitting right now. And then if I come back in, and let's just come in, one of the others that we're doing very well in, we're trading the energy market. If we look at gold, gold is on, this is a daily chart. Let's get it back up here so you guys can see it better. Here's the gold market right here, the daily of gold. You can see here it's very choppy. I am not in gold right now. I do not believe with low inflation that we've got, and by the way, lower oil prices is helping deflate the markets or create a deflationary environment. Right now you can see where gold is. It's just very choppy. It's very difficult to trade this particular type of pattern because it's just every day it's just a reaction to where the dollar is and where oil is and inflation reports. But I think longer term, gold is going to be up. Same thing with silver. I do believe longer term silver is going to be a nice play. And if we come in and look at silver, you can see right here. Let's get it back up here for you guys. You can see silver is going to be nice as well. It's going to be, I think, longer term. Silver's got a really good opportunity to move higher. Interim right now, I'm not even looking at it. It's still a down signal in my charts. The other one that's really interesting for us is oil. We've played oil to the downside. We had a nice break here, as you can see on this chart. Well, let's pull it up here. So we had a nice call on oil. You can see this boom break. Now, I didn't expect it to move this fast, but I did call for $50 oil as soon as we had the break here. I know some people said that's a little bit too low, but that's what I was calling. And this is where we're sitting here. Can we get lower? Absolutely. If I come into the weekly chart right here, you can see this low right here, right around, let's move it up here, right around 33.20. Okay, we came right down and touched, right down on the 46, but there's really nothing below us, right? I think oil is going to be very choppy down in this area here. My charts are saying that oil can go down even lower, so be careful. I'm trading oil right now in the futures market. I'm trading a consolidation pattern right now. If we look at oil, you can see here where there's really not much consolidation going on. I mean, I've got, because of the high volatility in the oil futures market, I'm able, from an option standpoint, to get really good premium on my trade. But this has been in a down mode for quite some time. You can see where we're sitting right here. Should we break this 46.83, like I said, we're coming down to 33.20. There is nothing but dry powder between the two. I hope we do get down there, because if we do, then I'm going to switch my focus and go long again. But I think fundamentally the whole market has changed around oil supply and demand, particularly with the U.S. coming in and supplying the globe with an additional 3 million barrels of oil a day, more than what it normally gets. So it should be a lot of fun. Same thing with oil or gasoline futures. You can see gasoline futures here. We haven't played this one in a while either, but I'm looking at this one for a really nice trade going forward also. So there's a lot of really good trades coming up, folks. Just as remember, as a reminder, we'll be closing off our holiday year-end special here in the next week or so. I'd highly encourage you to take advantage of it. It's a very low fee. You get 33% off our annual. We're doing a number of things in our group. I'm getting ready to start up in the next couple of weeks a options trade adjustment webinar series, education series. That'll go about 12 hours, maybe a little bit longer. If you're not a member, it'll be $199. If you are a member, it's free. I'd take advantage of it. And if you're not a member, and you can't attend the sessions, they'll all be recorded for you anyway. You'll be able to access them. But as a member, you'll have that plus all our educational webinars, as well as our Tuesday and Thursday sessions, our Sunday night sessions, which we got one tonight, as well as access to our chat room and then our secret trader trades that are going to be starting here pretty soon. All right, everybody, have a really great weekend. Enjoy the football playoffs, and I will be in touch with you guys later. Bye now.